Welcome back to the What's More podcast. I'm your host, Quentin Harris. In this episode, we're going to talk about that PCE reading that came in on Friday morning, and we're going to talk about unlocking the lock-in effect. And that's something we've discussed a lot of things about the lock-in effect. But now I want to tell you about why we think the unlock effect is going to happen and give you some interesting data from Q4 2022 moving forward about a lot of recent mortgages that were done that come in the total of about $2.7 trillion that could become available. So let's dive right into it. So let's talk about the PCE to kick things off. Obviously, we know the Federal Reserve is going to meet on Wednesday, a couple of days from now. And I think everyone's just kind of sitting back like in this wait and see moment. But a lot of it had to do with the pieces of the puzzle falling together for us. We had very favorable readings on the CPI. We had job reports that reflecting some things that we needed to see. You know, we're not rooting for anyone to lose their job, but we needed to see some, softening of the labor market. Unemployment rate crept to 4.1. So the missing piece here was the old pivotal PCE. And what we were looking for was something below expectations. What we got was a flat reading. And that's okay, I think. The flat reading doesn't affect or alter the course of what I think was going to happen on Wednesday anyways. Now, what I think we're going to see here is this. I think the Federal Reserve is going to step in there. I think if you go to the old Fed Watch tool, you probably see there's a small chance to nil they're going to do anything in July. They could surprise us all and come out with a quarter, but I think the pressure is mounting to the September meeting where we all know that that's going to be a rate cut. The question and the debate, and I think what's going to build between now and September, pending we continue to get these types of readings, is it going to be 50 basis points? Is that what we're looking at in September? If we continue to get more favorable CPI, more consistent at expectation numbers, nothing higher, and inflation's not roaring and rising, and it's coming at expectations, and we're beating expectations, and the job market continues to stay where it is, and that unemployment number goes up even further, I think you're going to see that September 50 basis point hike. But that's another podcast and another time. So here, I'm not the only one that thinks that. We take a look at Fannie Mae. Obviously, we all know who Fannie Mae is at this point. They're forecasting 2 more rate cuts by the end of the year. Now, we don't have that many meetings left. And to have 2 more rate cuts, that's some pretty big news. This 30-year fixed rate mortgage, here's what Fannie Mae's forecasting. I think it's interesting. They've got this thing getting down to 6.5, really mid-year of, fourth quarter of 2024. So we're already mid-year of 2024. They're saying by the end of the year, we're going to be at 6.5 and basically almost touching the upper fives in 2025. And what's interesting about this is they have they kind of have this other graph we're going to put in there, basically showing all the single family mortgage origination. And what they did was they showed the amount of purchases and refinances between 23 and then all the way to Q2 of 24. Then they forecasted out basically the fourth quarter and third quarter of 24 all the way through 25. What's interesting about this is they're expecting a significant fourth quarter. More importantly, Q2 and Q3 of 25, those are big numbers. Like these are big numbers, and the refinance numbers are getting bigger to reflect this as well. Again, this will be in our show notes at What's Your One More on the YouTube channel there. Go subscribe and check these out. But this is interesting to me because it provides a lot of insight and a lot of potential hope of what this market could look like. Now, you could argue and say, hey, hope's not a strategy. But what I'm saying is this. We hear from many of our audience members about how hard it is to buy a home right now. And it's either A, the price is too significantly high, B, the rates are too significantly high, and you just can't afford to live. This is going to help affordability if these rates get to where they need to be. And if you combine some of the solutions and some of the product features that we've talked about over the course of this show, you could really find yourself in a really good situation here on the interest rate. Now, the other argument is home valuations. Like, are they going to continue to keep going up? And unfortunately, for those that don't have a home, this forecast also indicates that home prices are going to continue to go up. And that's a natural maturation of when the rates come down, the prices of the home go up. That's just a logic that's always been tried and true because you've got all these buyers that are sitting on the sidelines that want to buy. And every seller is a buyer. For the most part, every seller is a buyer. So if people start to sell their homes and inventory starts to go up, they're going to be buying other homes. And then you're going to see this cycle that we continue to talk about. I think we use the analogy of musical chairs of people switching from selling to buying, buying to selling, vice versa. And that's going to drive home prices too, because you're going to be having a lot more people to the market to buy, and the inventory is just not there. We continue to talk about the depleted inventory level, even though this week, big week last week, we finally got a high level of inventory. Yeah, I know that sounds crazy, right? High level inventory to where we're actually in a moderate, balanced market potentially in the nation, not in some pockets, but potentially. And that's something we haven't seen in quite some time. So healthy inventory markets are good because it is going to allow for more opportunities for buyers, as well as when these rates drop, people are going to gobble that up. So here's the interesting thing I thought I wanted to share on here about that $2.7 trillion. The Jefferies Company, which is an investment banking firm, they indicated, and they use a term on here I like a lot called near the money pipeline. Near the money pipeline. I thought that was interesting because I hadn't heard that yet. But what they're saying is this, is that near the money pipeline is the definition of all the loans that were originated in Q4 of 22 to Q2 of 24. So over that year and a half period there, they're stating that the average interest rate ranged from about 6.25% to 8%. Pretty big range there, right? But what they're suggesting is, based on what I was saying about Fannie Mae, is that if the forecast of those models, if those interest rates drop to 6.5 at the end of 24, and we creep into the upper fives in 25, that $2.7 trillion worth of loans that were originated during that time frame, they're all not only eligible, but they're in the money, meaning that it makes sense for them to refinance. Now, I never really considered that, because when I look at the lock-in effect, I always looked at the people that were at 5% or below, what I thought were locked in because rates were just so arbitrarily higher than those rates. It didn't make sense. But what I never considered, and I should have, but I just didn't, was all, as we were talking about the lock-in effect over the last 18 months, we actually were creating another layer of loans that were going to be unlocked immediately, based on just the littlest of rate drops. Now, I know we always said, people that are refinancing, that whole, buy the house, date the rate concept, but that's a tongue twister when you say it like that. You always like emphasize the word rate there because it's a weird way of saying those two things together. But anyways, that 5.75, 6.5, that's going to unlock all those mortgages. What I didn't consider is that that's $2.7 trillion worth of mortgages. That's a lot of volume, a whole lot of volume. And I think that that's going to provide a shot of complete, much needed adrenaline to the mortgage industry, and also help those homeowners more importantly. And that's going to be a big win on here as I'm looking at this report that's in front of me here. So I see me keep looking at my computer because that's a big number. And going back to that Fannie Mae article, if you may, that where they came out with their survey and then talked about what their home price growth would be. The interesting thing is that they are also saying that, listen, if we look at new home builds, and the reason I bring this up is because new home builds are what backfill inventory. If we just sat on the same inventory and didn't build homes, we're going to have an extreme supply shortage. But unfortunately, that's not the case. Fortunately, that's not the case. We do have new build growth taking place. It's no secret that the builders have been a little gun shy at their build rate right now. And if you think about it, like the homes that you see completing right now are going vertical. Those were homes that were started anywhere from 8 months to 14 months ago. But it's a limited number. You're not seeing a lot of new foundational ones just going up right away or being cleared, or, a lot of vacant lot development taking place, because the reality is the builders are gun shy about the mortgage interest rates. And we've seen a lot of builder confidence surveys, and then we've seen a survey of the top 100 builders and their CEOs do a survey that we get from Zonda, once a quarter. And inside there, they're concerned about the traffic. They're concerned about contract fallout. They're concerned, number one priority is interest rates. And that's why you see a lot of builders offering everything they can to get that rate down. Buy downs, 2-1 buy downs, all of the incentives you can use towards the rate, because they're trying to move product and hold and maintain that level of the price point of the home. That's the one thing they don't want to reduce, is the price point of the home. The other thing is their margins are slim. I mean, there's only so much profit in that home. So if you start cutting the price of the home, you're cutting that margin, which is already slim to begin with. So the builders are saying, hey, listen, we saw what happened in 2008, and those higher rates do concern them, looking at what happened in 08 and 09. And what happened was we had way too much supply and we didn't have enough demand. Well, they're going back to theology and said, hey, listen, we learned from those mistakes. We're not going to overbuild again right now. So that's why you're seeing a pullback on the new build. And it's reflecting in the inventory. Well, in this survey, this report, I don't know why I keep calling it a survey, but in this report on the Economic and Strategic Research Center of Fannie Mae, on their group, what they're saying is, hey, listen, we absolutely think there's going to be a rise in new home builds. But they actually revised it, and they said they think it's going to be less than what they originally forecast. I thought that's interesting because as rates come down, I would expect to see that grow a little bit higher, but they think it's going to be a little bit less. And again, I'm going to put that graph in there so that you can see this here because at our YouTube channel, What's Your One More, the reason this is interesting is because that's telling me there's going to be even further tightening of the inventory market in the good times when rates drop, which could give the upper hand to the existing home sales, meaning price points are going to go up. And that just kind of debunks everything that you keep hearing online. And this is data sets. These are data facts, data sets. Forecasts are not data facts. I know they're forecasts. But what are facts right now is that our inventory supply does not match the level of demand in the form of, hey, listen, we have so many homes out there being sold that naturally the price points are going to drop. That's not what's going to happen. We have a near balanced market. And I think you could argue it's not balanced enough. But the home prices are continuing to go up in areas. Now, for those of you on YouTube that have turned around and made comments and shared with us your local markets and where you're living, we had a person comment about Austin. Yeah, that person was dead on. That's a pocket, right? Austin has had significant issues and, led by property taxes and a very quick rise up over the last 5 years. But, those were significant gains. Even if Austin has gone back, I could say, let's just say it's going backwards 10%. I don't think that's it. Maybe let's say 15. That's still the people that had owned homes for the last 5 years are still in the money. They're still significantly have done well, and that 10, 15 is, backwards. If that's where it's going, that's not a significant downward trend unless you bought that home in the last year. Quite frankly, the people that own those homes longer that are still doing very well, but the reality is you could look at other markets where the homes are still going up in value. As I do this podcast, I sit right here in Jacksonville, Florida, and yeah, we have pockets at the beach and pockets on the intercoastal and then pockets across the city that are flat, but we have other ones that are going up, and we have homes that are sitting, but the price points aren't coming down. So, it just depends on where you live, but the reality is nationwide home appreciation is up. And we see that in multiple indexes that we're getting from the FHFA, and we're seeing it in the Case-Shiller. So, we are still seeing that. Imagine what happened. And guys, this is as we said today, rates are about 7. What happens when these rates do get in these 6s and this upper 5s? That's going to explode. So, I would say this. I would say that what I'm looking at here and what news we got last couple of weeks, all the encouraging news, a rate drop is inevitable. It's coming. Fourth quarter is going to be big. Let's see what it does for home prices. But if I had to bet, if I had to double down, you're going to see home prices go up greater than what they're doing right now. And you're also going to see what appears to be a flurry of refinances to the tune of $2.7 trillion. So good times are on the way for the mortgage industry as well as the consumer for the win to lower their overall monthly affordability. That's a big win. So guys, if you like what you're hearing, please share this podcast. Please 5-star review us. Check us out on any platform you listen to your podcast, and tune into our YouTube channel for all of our graphs and show notes, and subscribe to the channel. We'd love to hear from you on there. Till the next episode, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my